What's going on, everybody? This is Kenyon Hackworth from Healthy You, Wealthy You, where my focus is on improving health and building generational wealth. Today, I'm going to talk about what I believe is the true key to building wealth long term, and that is the power of compounding. Now, there are three components that go with building wealth through investing. It's time plus dollars invested plus your CAGR, which is your compound annual growth rate. Those three factors working together are the ones that help you build wealth. Now, if you start early, if you start younger, you have time on your side. It doesn't take as much money to be invested, and your compound annual growth rate does not have to be as much for you to build the same amount of wealth. Now, if you are a late starter, like I started investing at the age of 33, you have to invest more money. Plus, what's really beneficial is to have a higher compound annual growth rate. Einstein said that compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So what I want to do is I want to differentiate between simple interest and compound interest. Simple interest is interest that's paid on the principal only. It does not compound. Compound interest, on the other hand, is paid on the principal and is also interest on the interest once it's reinvested. Here on this chart, you see two different examples. On the left side, you see simple interest. We're starting with $10,000, and we're looking at 20 years. So let's say it's you're investing in a bond. You have a 20-year bond. You're putting in $10,000, and at the end of 20 years, you get your $10,000 back. But at the same time, you're paid 10% interest every single year. So that 10% interest, each year you get paid $1,000 all the way up through year 20. And at the end of 20 years, you will have $30,000 because you've been paid $1,000 every year for 20 years, plus the original $10,000 investment. So your total would come to $30,000. Now, compounding is different because the interest is paid on the principal, and then that money is then reinvested back into the principal, and then the interest is paid on top of the principal and the interest. For example, you start out with $10,000, you're paid 10% that first year, which is $1,000. That $1,000 is then reinvested back, and now you're starting out year two with $11,000. 10% of that is $1,100, and that is reinvested back into there. And then by year three, you're starting with $12,100. So that continues on for 20 years. And at the end of 20 years, you end up with $67,275, which is a lot more than the $30,000, which is more than double the $30,000 from simple interest. So here you can see on this compound interest calculator, which can be found at investor.gov. If you invested $10,000, you held it for 20 years at 10% interest rate or compound interest rate, and after 20 years, you will have $67,275. Now, your compound annual growth rate, we're going to talk about that in relation to the rule of 72. The rule of 72 is a mathematical formula that tells you how long it takes for your money to double. So what you do is you take 72 and you divide it by the growth rate. For example, if you have a compound annual growth rate of 10%, you take 72 and you divide it by 10, then that would tell you that your money would double every 7.2 years. Now, the higher the compound annual growth rate, the faster your money is going to compound. So on this chart, we're looking at how long does it take for your investment to double 7 times. We're still starting with the $10,000. You can see that $10,000 doubling once will go to $20,000, then to $40,000, then to $80,000, all the way down to $1.28 million when it doubles 7 times. Now, if your compound annual growth rate is 8%, you take 72 and you divide it by 8, your money will double every 9 years. If your compound annual growth rate is 10%, your money doubles every 7.2 years. If it's 12%, your money doubles every 6 years. 14.4%, your money doubles every 5 years. 18%, your money doubles every 4 years. And 24%, your money would double every 3 years. So an 8% compound annual growth rate, your $10,000, it would take 63 years for your $10,000 to grow into $1.28 million. Now, this is just a one-time $10,000 investment. No additional capital is added, and it's just growing at that particular interest rate. So if you invest $10,000 for 12 years, it would take you 42 years at 12% to get to $1.28 million. At 18%, it would take you 28 years to get to that amount. And at 24%, because your money is doubling every 3 years, it would take 21 years for $10,000 to grow into $1.28 million. Now, here's an interesting thing. If $100 had been invested on the day I was born into Walmart, say I bought Walmart stock, or someone bought Walmart stock for $100 worth of Walmart stock for me on the day I was born, on my 47th birthday, that $100 would have grown to over $1 million because it compounded at 21.8% a year. Now, I know you think, like, how in the world can $100 grow into $1 million? See, that is the power of compounding. Compounding is so powerful. So how $100 becomes $1 million in 47 years? So again, you take 72, is the rule of 72, and you divide it by the growth rate. Walmart grew at 21.8% for that 47-year time period. You take 72, you divide it by 21.8. So the money would double every 3.3 years. Now, these are just approximate because, there are cents and there's dollars and cents and all that stuff involved. But over 47 years, money doubling every 3 years would mean the money would double approximately 14 times. So starting with $100, it will double from 100 to 200, then 200 to 400, 400 to 800, and then 1,600, 3,200, 6,400, 12,800, all the way down to over $1 million by year 14. That's why compounding is so powerful. That is why Einstein said is that he called it the eighth wonder of the world. It is so powerful how your money can compound and how it can grow at very exponential rates if you have a higher compound annual growth rate. So let's look at Apple, for example. So I put $14,000, and I did this for a reason. So $14,000 invested in Apple in 2012, held for 10 years. Apple will be worth $222,000 today because Apple compounded at north of 31% a year for the last 10 years. If you go back even further, and starting in the year 2007, now this is before 2008, which was the housing stock market crash where everybody lost all their money. If you had invested in Apple in 2007, the year before the crash, now Apple was down about 50% in 2008. Even though if you had done nothing but just held on, which is what I always recommend for great companies, you just held on for that time period, that $14,000 would be worth almost $1.2 million today, compounding at 34% a year for the last 15 years. So let's go back a little bit further. Let's say you had invested in Apple in 2002. $14,000 will now be worth $8.4 million because Apple compounded at 37% a year. So at that rate, your money is doubling almost every 2 years. And because I know that compounding is so much more intelligent than I am, that's one of the reasons why when you own great businesses, I always say you own great businesses, all you have to do is just nothing. You just hold them. Just allow them to compound. So we'll take a look at Apple from my own portfolio, from my Roth account. So I have Apple in different accounts, but this Apple is in my Roth account. So 408 shares is what I own in my Roth, 408 shares. And the average cost is $34.65 per share. At the time of this taping, Apple's stock price is $173. So the cost basis is a little bit over $14,000. Now this is money that's been added plus any dividends that have been reinvested. The current market value of these Apple shares is $70,000, which has grown by a total of $56,000. Now you think about the compound annual growth rate. So a lot of people look at it as Apple grew by $56,000. But in reality, the way I look at it is Apple doubled twice. Apple was on its third doubling cycle in my portfolio. So it's doubled from 14,000 to 28,000, and then 28,000 to 56,000. So now it's on its third doubling cycle. Now, if it grows the same rate over the next 5 or 6 years as it has the last 5 or 6 years, it won't grow by $56,000. It will double twice again. So it will double from 70,000 to 140,000, and then 140,000 to 280,000. So that's just one of the reasons why you find a group of really good, outstanding businesses, and you buy them and hold them. There's nothing else for me to do. Now, this is in a Roth account. So the Roth account, once it grows, I'll make another video on Roth accounts and why I love a Roth IRA. Roth accounts, whatever the money grows into, is all tax-free because I don't have to pay any taxes on it in the future. Now, I know two things. Number one, I know I have no idea what Apple is going to grow into over the next 15 years. But I also know that I'm smart enough not to sell it. I'm smart enough to know that Apple has compounded. If I look back and I say Apple has compounded at 30% a year for the last 20 years, and it's just had a blowout quarter recently, and it ended this quarter with $200 billion in cash, I know that I'm not selling my Apple stock because I am a shareholder. I am part owner of the company. If you look at stocks as part of a business and realize that when you are investing, you are buying a piece of a business that your family can own for generations. Apple is going to be around for a long, long time, and it will continue to compound because they make a lot of money. And they do a really good job of returning capital back to shareholders. So I know, and that's one of the reasons why, there's a couple of reasons why I don't trade in and out of stocks. Number one is because it's not necessary. Number two is because it hurts performance. It hurts the individual investor, especially if you have outstanding companies that you own that are compounding your money at a high rate. It hurts you to buy and sell and move money around and trade in and out. It does not hurt the person who's telling you to rebalance and trade and move money around, or you got to take profits and you have to do all that stuff. It doesn't hurt them. It helps them because every time you rebalance, every time you sell one stock and buy a new one, it comes with fees, transaction costs, and commissions. So it helps the person that tells you to do all this stuff, but it doesn't help the individual investor. The individual investor, for myself, what I do is I look for a group of great businesses. Now, I'm well aware that any point, anytime, any company that I own can be down 20% or 30% or 40% at any given year or in a moment. But one company is not going to destroy my portfolio. In fact, I own Netflix, and Netflix was down 21% in a day just last week. You know, that didn't cause me to panic and be like, oh my God, Netflix is going to zero. I'm going to lose all my money in investment. So I looked at Netflix, and Netflix at that particular point, it became a more attractive company. In fact, Reed Hastings, who's the CEO of Netflix, just invested $20 million of his own money to buy more shares of Netflix. But that's a different story. That's a different story for a different day. And I'm not recommending for anybody to go out and buy Netflix stock or even Apple stock. You have to make your own financial decisions. But the key is, I know that if I own a group of great businesses, my money will compound at a high rate, and eventually I end up with a lot of money. More money than I can make myself. My money will make more money than I can make because of the power of compounding. So allow your money to compound, allow your money to grow, and allow time plus the power of compounding to build your wealth. All right? I will talk to you soon. Have a great day. Keep investing. Be consistent. Invest consistent every single month. Do not stop investing. Do not stop building your wealth. Regardless of what's going on in the market, keep investing. All right? I will talk to you soon. Peace.